stop what you're doing right now. I need you to lock in for the next several minutes, because what I'm about to share with you is not speculation, it's not theory, and it's not another financial headline you scroll past on your phone. On January 15, 2026, the Federal Reserve quietly published an updated framework for reserve requirements that fundamentally changes the relationship between your cash deposits and the banking system, and nobody is talking about it. The reserve ratio for commercial banks with total assets exceeding $50 billion has been reduced from 10% to 3%. Let me break down what that means in plain English. For every $100 you deposit into your bank account, your bank is now only required to hold $3 in actual reserves. The other $97 can be loaned out, invested in securities, or used as collateral for derivative positions. Your cash is no longer sitting in a vault, it's actively being leveraged. And the buffer that protected you from bank runs and systemic stress has just been cut by 70%. This is not a crash. This is not a panic. This is not a rumor circulating on financial Twitter. This is a regulatory change that has already been implemented, and it tells you something critical about what the Federal Reserve sees coming. They are pre-positioning the banking system for a liquidity crisis by allowing banks to operate with thinner capital cushions, which means they expect institutions to need every available dollar of lending capacity in the months ahead. And here's what the mainstream media won't tell you. When central banks start loosening reserve requirements in the middle of what they claim is an economic expansion, it's not because things are going well. It's because they're preparing for what happens when the credit mechanism seizes. This is desperation masked as policy flexibility. Now let me walk you through exactly why this matters more than any interest rate decision you'll hear about on CNBC. And more importantly, I'm going to show you why gold and silver have become the only real protection you have left in this environment. Before we go any further, you need to understand the framework that governs every financial system in history. It's called fractional reserve banking. And if you don't understand this, you cannot possibly grasp the risk you're taking by keeping significant wealth in the traditional banking system. Fractional reserve banking means that banks do not hold all of your deposits in cash. They hold a fraction and they lend out the rest. This system works beautifully when confidence is high and defaults are low, but it collapses catastrophically when depositors lose confidence and attempt to withdraw their money simultaneously because the cash simply does not exist. The reserve requirement is the regulatory guardrail that's supposed to prevent this collapse. It's the percentage of deposits that a bank must hold in liquid reserves, either as physical cash in the vault or as deposits at the Federal Reserve. For decades, that requirement sat at 10% for large banks. It wasn't perfect, but it created a baseline level of liquidity that could absorb moderate stress. On January 15th, that baseline was lowered to 3%, and I need you to understand what this means in practical terms. If you deposit $100,000 into a checking account at a major commercial bank, that bank is now only required to keep $3,000 available. The other $97,000 is immediately deployed into the lending market, into securities purchases, into repo agreements, into the complex web of financial instruments that generate profit for the bank. And here's the critical point that keeps you up at night. That $97,000 you think is yours is now somebody else's loan, somebody else's mortgage, somebody else's corporate bond. It has been re-lent multiple times over through what economists call the money multiplier effect.
If you and everyone else with deposits at that bank decided to withdraw your money on the same day, the bank would have $3,000 for every $100,000 in claims. That is a 97% shortfall, and there is no mechanism to cover that gap except emergency borrowing from the Federal Reserve. This is not a flaw in the system. This is how the system is designed to function, and the Federal Reserve just made it 70% more fragile. Now let's talk about why this is happening right now in this specific moment, because timing is everything. The United States is carrying over $36 trillion in federal debt. Corporate debt has exceeded $13 trillion. Household debt is approaching $18 trillion. We are sitting on the largest debt pile in human history, both in nominal terms and as a percentage of GDP. And that debt was accumulated during a decade of near-zero interest rates when borrowing was essentially free. But rates are no longer near zero. The Federal Reserve raised rates aggressively in 2022 and 2023 to fight inflation. And even though they've paused or cut modestly since then, the damage has been done. The cost of servicing all of that debt has exploded. Corporations that borrowed at 2% are now refinancing at 6 or 7%. Governments that issued bonds at rock-bottom yields are now facing fiscal crises as interest payments consume larger and larger portions of tax revenue. And consumers who took out variable rate loans are seeing their monthly payments double or triple. This creates a deflationary feedback loop that the Fed is terrified of. Higher debt service costs mean less money available for consumption and investment. Less consumption means weaker economic growth. Weaker growth means lower tax revenues and higher default rates. Higher default rates mean banks take losses on their loan portfolios. And when banks start taking losses, they pull back on lending, which makes the deflationary spiral worse. The Federal Reserve knows this, and they also know that the traditional playbook of lowering interest rates to stimulate borrowing is politically and economically constrained because inflation is still above target. So instead of lowering rates, they're doing something more subtle and far more dangerous. They're lowering reserve requirements to free up bank capital for lending without having to cut rates. This is financial engineering at its finest, and it's a signal that the Fed is more concerned about a credit crunch than they are about the safety of your deposits. According to FDIC data, United States banks were holding approximately $650 billion in unrealized losses on securities as of Q3 2025. That's $650 billion. Your deposits are backing assets worth significantly less than their book value, and the Fed just told these same banks that they can operate with even less liquidity cushion. Meanwhile, commercial real estate delinquencies are accelerating. Office buildings, retail centers, and even multifamily properties are seeing rising vacancy rates and falling valuations. According to data from TREP, the delinquency rate on commercial mortgage-backed securities hit 6.8% in December 2025. It's the highest level since 2014. And remember, regional banks hold approximately 70% of all commercial real estate loans in the United States. When those loans start defaulting, the losses flow directly onto bank balance sheets that are already strained. Over $1.5 trillion in commercial real estate debt is maturing in 2026 and 2027. The vast majority of it cannot be refinanced at current interest rates without the borrowers injecting massive amounts of new equity. Many borrowers don't have that equity, which means they'll default, and the banks will be forced to take ownership of properties worth far less than the loan balances. This is a slow-moving train wreck.
And the reserve requirement cut is the Fed's way of giving banks more breathing room to absorb the losses without having to raise capital or curtail lending. But it comes at the cost of systemic stability. It comes at the cost of your safety. Now let me show you the historical precedent, because this is not the first time reserve requirements have been used as a crisis management tool, and every single time it has ended badly. In the lead-up to the Great Depression, reserve requirements were inconsistent and often inadequate. Banks operated with thin capital buffers, and when the stock market crashed in 1929 and the economy contracted, depositors lost confidence and rushed to withdraw their funds. Between 1930 and 1933, over 9,000 banks failed, wiping out the savings of millions of Americans. The lesson learned from that catastrophe was that reserve requirements matter. They are a critical buffer that prevents isolated shocks from becoming systemic crises. Then we had the savings and loan crisis of the 1980s and early 1990s. Savings and loan institutions got caught in a brutal interest rate squeeze. They had issued long-term fixed-rate mortgages at low rates, but when Paul Volcker raised rates aggressively to fight inflation, the cost of their deposits skyrocketed, while their mortgage income remained fixed. This created massive losses. Over 1,000 institutions failed between 1986 and 1995. The total cost to taxpayers was over $130 billion, equivalent to over $300 billion in today's money. And of course, we all remember 2008. Banks had leveraged themselves to absurd levels, and when the housing market collapsed, the entire system nearly went down with it. The response was supposed to be a return to prudence. Dodd-Frank and Basel III regulations were implemented to increase capital requirements and reduce leverage. But here we are in 2026, and the Fed is moving in the opposite direction, cutting reserve requirements at a time when systemic risk is arguably higher than it was in 2008. In March 2023, Silicon Valley Bank collapsed in the second largest bank failure in United States history. It was followed by Signature Bank and First Republic, all within a matter of weeks. The Federal Reserve and the FDIC intervened with emergency backstop facilities. That intervention worked in the short term. The panic subsided. But it didn't solve the underlying problem. And now the Fed has told these same vulnerable banks that they can operate with even thinner reserves. Here's what most people miss, and this is where the systemic risk becomes terrifying. When a bank holds only 3% reserves, it means that 97% of deposits are tied up in illiquid or semi-liquid assets, loans, bonds, derivative securities. If a shock hits the system, whether it's a wave of corporate defaults, a commercial real estate collapse, or a geopolitical crisis that spooks markets, those assets can lose value rapidly. But the deposits, your deposits, remain as liabilities on the bank's balance sheet at full face value. This creates an instant solvency problem. The bank owes you $100, but the assets backing that liability are now worth $80 or $60 or even less. If you try to withdraw your money, the bank has to sell assets at a loss to raise cash, which makes the solvency problem worse. And if other depositors see the bank selling assets at a loss, they panic and try to withdraw their money too, which forces more asset sales at even steeper losses. This is the classic bank run dynamic, and the Fed just made it 70% easier to trigger.
If you have deposits above the FDIC insurance limit of $250,000 in any single institution, you need to understand something very clearly. You are an unsecured creditor, and in a bank failure, you could lose access to those funds or have them converted into equity in a failing institution under bail-in provisions. Your money is not as safe as you think it is.
Now, let me connect this to something even bigger that's happening on the global stage. Because while the United States banking system is becoming more fragile, other nations are positioning themselves for what comes next. Just a few weeks ago, Treasury Secretary Scott Bessent testified before Congress and made some remarkable admissions. When asked about China building an alternative financial system, he said, and I quote, "There are lots of rumors of Chinese digital assets that may be backed by something other than the RMB, perhaps gold-based. I would not be surprised." Let me repeat that. The United States Treasury Secretary just admitted that China may be building a gold-backed digital currency system, and he would not be surprised if they do it. China has been buying gold for 15 consecutive months. In January alone, they purchased another 40,000 ounces at all-time high prices, above $5,500 per ounce. They're not slowing down, they're accelerating. And it's not just about building forex reserves. Gold is a critical pillar in China's plan to create an alternative financial system that doesn't depend on the US dollar. Their digital yuan transactions have exploded from $250 billion in 2022 to over $2.3 trillion last year. That's almost 10x growth in just 3 years. And through Project mBridge, they're connecting this system to other central banks around the world. Transactions on that network have gone from just 160, totaling $22 million under BIS leadership, to over 4,000 transactions totaling $55 billion now that China has taken control. Over 50 nations are now working with China to build payment systems that bypass the US dollar entirely. They're doing this because the United States has weaponized the dollar through sanctions. Bessent even admitted in Congress that dollar sanctions caused one of the largest banks in Iran to collapse, triggered a currency freefall, and sent people into the streets. Other countries are watching this, and they're deciding they don't want to be next. So they're moving to a system backed by something real, something that can't be printed into oblivion, something that can't be sanctioned or frozen or seized. They're moving to gold. And this brings me to the most important part of this entire video: why gold and silver are your only real protection in this environment. Physical gold and silver are the only assets that have zero counterparty risk. Let me explain what that means. When you hold a bank deposit, you have counterparty risk. You're depending on the bank to remain solvent, to honor its obligations, to not get caught up in a systemic crisis. When you hold a bond, you have counterparty risk. You're depending on the issuer to not default. When you hold stocks, you have counterparty risk. You're depending on the company to remain profitable and the market to remain functional. But when you hold physical gold or silver in your possession, you have no counterparty risk. There is no institution between you and your wealth. There is no balance sheet that needs to remain solvent. There is no digital ledger that can be frozen or hacked or manipulated. An ounce of gold is an ounce of gold. It has been money for 5,000 years across every civilization and every currency crisis in human history. Central banks around the world understand this. That's why they purchased over 1,000 metric tons of gold in 2024, the second highest annual total on record. China, Russia, India, Turkey, and Middle Eastern sovereign wealth funds are all accumulating. They're not doing this because gold is a speculation. They're doing this because they understand that in a world of fiat currency debasement and systemic banking fragility, gold is the ultimate reserve asset. They're building their ark before the rain. They know the storm is coming. The question is, do you? Silver has the same properties as gold, with additional upside. It's both a monetary metal and an industrial metal.
Solar panels, electric vehicles, electronics, artificial intelligence infrastructure, all of these require silver. Demand is exploding, while supply remains constrained. We've had a supply deficit for 5 consecutive years. And unlike gold, most silver gets consumed in industrial applications and is never recycled. The gold-to-silver ratio right now suggests silver is historically undervalued compared to gold. When this ratio corrects during precious metals bull markets, silver typically outperforms gold by multiples. In 1979 to 1980, silver went up 5x in just 5 months. In 2010 to 2011, it doubled in 7 months. The same technical breakout patterns are appearing now. If you don't have at least 10 to 20% of your liquid net worth in physical precious metals stored securely outside the banking system, you are taking on uncompensated systemic risk. You are trusting a system that just cut its safety buffer by 70%. You are trusting institutions that are sitting on $650 billion in unrealized losses. You are trusting a currency that central banks around the world are actively trying to replace. So what should you do right now? Let me give you the specific actions. First, assess your exposure to the banking system. If you have deposits above the FDIC insurance limit of $250,000 in any single institution, you need to spread those deposits across multiple banks or move excess funds into physical assets outside the system. Second, build a position in physical precious metals if you haven't already. This is not a trade. This is insurance against systemic breakdown and currency debasement. Work with reputable dealers, take delivery or use fully allocated segregated storage. Avoid numismatic premiums or paper substitutes like ETFs. You want metal you can hold or metal that is specifically allocated to you in a secure vault. Third, reduce your exposure to long-duration financial assets, especially bonds and bond funds. In an environment where reserve requirements are falling, credit risk is rising, and inflation remains a threat, locking in low fixed returns for 10 or 20 years is a guaranteed wealth destroyer. Fourth, understand that the rules have changed. The buffer has been removed. Your cash is now leverage on a bank's balance sheet, not a guaranteed claim. This is not about fear. This is about understanding the system as it actually operates and positioning yourself accordingly. Here's my question for you. Knowing that reserve requirements have been cut to 3%, knowing that banks are sitting on $650 billion in unrealized losses, knowing that China and 50 other nations are building an alternative financial system backed by gold, do you feel confident keeping the majority of your liquid wealth in bank deposits, or does this change your risk assessment? Let me know in the comments below. I read every single one. If you found this breakdown valuable, if you understand why this reserve requirement change is a red flag and not just a technicality, then do two things for me. First, smash that subscribe button and turn on notifications because I'm tracking this situation in real time, and I'll be breaking down new developments as they happen. Second, share this video with anyone you know who has significant assets in the banking system and who trusts that their deposits are safe simply because they've always been safe. The rules have changed. The buffer has been removed. Your cash is leverage now. The only question is whether you're going to act while you still have the optionality to move, or whether you're going to wait until the exits are crowded and the liquidity has dried up. Gold and silver have protected wealth through every banking crisis, every currency collapse, every systemic failure in human history. They will protect you through this one too, but only if you own them before the storm hits. I'll see you in the next one. Stay sharp, stay informed, and stay ahead of the curve.